Good morning. This is Chris Hughes with M&A Services, here this morning to give a presentation on the M&A process overview. This process is focused on how to sell an insurance agency or an insurance distribution firm. Just a little bit about M&A Services, stands for Merger and Acquisition Services. We've been around since 1995. We're a boutique investment bank that exclusively serves the insurance industry, both on the distribution side. I'm the Managing Director of Insurance Distribution, and do anything that has to do with retail insurance agencies, wholesale insurance agencies, management companies of RRGs, MGAs, MGUs, program administrators, any type of firm that sells the insurance product. Those are the type of firms that we describe as insurance distribution firms. Our practice also involves the sale and purchase of insurance carriers. That would be shell insurance carriers, P&C carriers, life and health carriers. So we cover the entire insurance spectrum there. We also have a sister company, M&A Capital Services, where we do some capital raising activities, fairness opinions for boards, valuations, and diligence services. There's 12 members of our firm across our main office in Midtown Manhattan, small office here in Connecticut, an office in Palm Beach Gardens, Florida, an office in Atlanta, Georgia, and a two-person office in the Cayman Islands. With that, I'd just like to get started. This should be a 20 to 30 minute presentation. I'm going to share my screen now. Again, this is an M&A process overview for the sale of an insurance distribution firm. Putting together this presentation was myself, again, Managing Director of Insurance Distribution, and Stephen Scales, one of our resident CFAs, Chartered Financial Analyst. He's a senior associate here, helps build out all of the pro forma financials, the SIMs, the marketing materials, manages process with us, key member of our team here. The key objectives when looking to consider selling your insurance agency could be to monetize your investment, and this is the primary reason almost anyone goes in to sell their insurance agency, is take their investment in their insurance agency and monetize that. That can be through 100% sale for cash. That can be monetizing 75% in cash, 25% in buyer's equity. That can be selling 75% and keeping 25% in equity. But one of the key objectives in all sales is to monetize some portion of the insurance agency's equity. Another key objective we often see is access to markets. So a lot of smaller agencies might want to join a larger regional or national agency so they can access additional carriers, or if they have an acquisition or an aggregation strategy to access more capital. A lot of banks have lending limits of 10, 20, or up to $30 million, but once you run it up to your lending limit, you need to access primarily private equity capital to continue to grow. Or if you're an MGA or a wholesaler, oftentimes you might merge with a regional or a national firm to access additional retail distribution agencies throughout the U.S. So the growing an agency through either additional carriers, additional distribution, additional products, or the need for growth capital. Those are other reasons that people decide to sell their insurance agency or sell a part or whole of their agency. Enhanced revenues and expense structures. So a lot of times smaller agencies may be accessing a lot of carriers through wholesale agencies, and by going through a wholesale agency, there's a commission structure that might look like 8 to 10%, whereas if you could go direct to the carrier, you might get a 12 to 15 or even higher, depending on the product being sold, a much higher commission structure. So that enhances your revenue. By aggregating premiums, a lot of carriers, you get to optimize contingent commissions or profit sharing agreements. And then also on the expense structure side, if you're merging 2 or 3 or 4 agencies together, there are some expense redundancies like systems, accounting, controllers, just overall infrastructure. You don't need double or triple as you add agencies together. So 1 plus 1 usually equals 3 when you're doing acquisitions. Outside business interest, A lot of times insurance agency owners are just looking to do something different. We've had folks that want to leave the insurance industry altogether and start something else. We've had retailers that found a specialty niche within their retail agency and say, hey, we think we can develop a specialty product and we want to develop an MGA and distribute that product through retail agencies. So just other interest outside of their retail insurance agency. And then lastly, right now there's a lot of private equity in this space, and there's a lot of opportunity for one, not just to monetize your investment in the sale of your insurance agency, but also to be able to invest in a private equity startup. Examples would be Choice Financial, the Hill Group, World Insurance, Assured Partners. All of these firms, as part of the consideration in buying an agency, will offer you some portion of that consideration as their stock. And that's not stock that anyone can go buy out in the open market. That is, a unique investment opportunity just at the time that you're selling your insurance agency. So those are some of the key objectives that people consider when looking to sell their insurance agency. Now there's kind of a distinct process and stages in selling that, and we're going to go through that in detail here. So the first stage is preparation. So one, you have to go through and gather initial information, a lot of financial information, some of your operational information, salary rosters, things like that. And you gather that along with your M&A advisor. And what we do is we go through that, especially your financial information, your income statements, your balance sheets, and we put together pro formas. This is adjustments to your actual income statement that shows, hey, this is what it looks like once it's not ran as a privately held business, but much more as a corporate run business. We'll put together a confidential information memorandum. We'll put together an anonymous 1- or 2-page fact sheet or teaser and a draft non-disclosure agreement. During that time that we're putting together the financials, we're also going to develop an approved investor list alongside the seller. And this will be a list of investors or buyers that we think would be the best fit for this company, both strategically as well as would be able to pay the most financially. And then we're going to create a valuation that we think the company's worth, as well as show you a couple of different deal structures that we think would fit, this particular deal and satisfy what the seller is looking to accomplish. And again, that could be through pure cash at closing. That could be retaining an equity stake in your own agency and selling a majority stake of it. That could be selling a majority stake of your agency, keeping a stake, and also investing in the buyer's equity as well. Sometimes there's some seller financing piece to it, but I'd say that's more on the rare side, with the buyer's equity being probably one of the more common aspects we see to it, as well as what earnouts look like. In general, right now, it's a very expensive and hot seller's market. So most of the earnouts, mostly you get all of your closing consideration at closing, and then the earnout is based on a compounded annual growth rate over a period of 1, 2, or 3 years. And it's really just icing on the cake for any kind of growth that the agency is going to have over the next 1 to 3 years post-closing. So in this first stage, it takes anywhere from 30 to 45 days to do. And it really, the bottleneck there on whether it takes 15, 30, or 45 days is how fast the seller can present the financial information needed to put together the pro formas and to put together the confidential information memorandums. The key deliverables in this stage are to finalize the CIM, confidential information memorandum, the fact sheet, the NDA, finalize the investor list, and then develop a go-to-market strategy. Are we going to go to 5 buyers? Are we going to go to 15 buyers? Are we going to go to private equity? Are we going to carriers? Or is it just regional buyers? Who are we going to go to? And are we going to run a 1-stage process or a 2-stage process? Those are kind of the key deliverables in deciding what to do in the first 45 days here. Then we enter stage 2, marketing. So your M&A advisor will then reach out to all of the buyers that we finalized in stage 1, we will send over draft NDAs, and we will send over the anonymous fact sheets. I'll show you an example of what a fact sheet looks like going forward, but it's anonymous, so it has enough information that it would pique a buyer's interest without really letting them know anything, wouldn't have any identifiable information for the seller. So we'll distribute that for buyers and investors that read the fact sheet and say, yes, we're interested. They'll either mark up the non-disclosure agreement or sign the non-disclosure agreement. It's a mutual NDA that goes back and forth between each buyer and the seller. Once those NDAs are signed, then we send the confidential information memorandum to that specific buyer. In general, depending on who the buyers are, and if they have a legal department or outside counsel looking at NDAs, there could be, back and forth with red lines. That NDA process takes anywhere from, say, 3 to 7 business days to put in place for all of the buyers that we contact. So that takes, 1 to 2 weeks to send all the buyers the fact sheets, trade back and forth with redlined NDAs and get those executed and distribute the SIMs. Once we have all the SIMs delivered, SIM stands for Confidential Information Memorandum, we set up and coordinate management meetings. Those could be a lot of times with Teams or Zoom meetings, but oftentimes we'll schedule 3 to 5 management meetings in person, back to back. Usually these are anywhere from 1 to 3 hour meetings. Sometimes they go over from say 10 a.m. to 1 p.m. and have a lunch. Sometimes they go from 3 to 5 and have a dinner. A lot of in-person meetings. We're seeing that a lot more, several years post-COVID, but a lot of times, depending on the location of the seller, if it's really a tough place to get to, Teams meetings really, those 1 to 2 hour Teams meetings will have to suffice. Once we get through all of the meetings, and again, just to give you an example, if we went to 15 buyers, we would expect, probably all 15 to be interested and to reach a signed non-disclosure agreement and review the SIM. Out of those 15, we would probably expect, 10 of them to read the SIM, have enough interest to go to the next step and conduct a management meeting. Those management meetings are both for the seller to interview the buyer and ask all the questions they can of the buyer, and for the buyer to get to know the seller. You'll figure out cultural fit. You'll ask about each other's equity, ask about what the seller's looking to accomplish, what the buyer's looking to accomplish, why the buyer thinks it's a good fit, all the things that, all the questions and answers that buyers and sellers would have for one another. From there, once we've had the management meetings, your M&A advisor will reach out to all of the buyers, solicit interest and say, we're going to have letters of intent due, let's say, Friday at 5 p.m. Usually give everyone, 5 to 7 business days notice of when they can put together their offers. Letter of intent is a non-binding written offer for the buyer to buy all the key terms that go into a purchase agreement will go into a non-binding letter of intent. Those are generally 2 to 5 page signed documents by both the buyer and seller, but only a couple of the provisions are binding. We'll go through what the key components of a letter of intent are later on in this presentation as well. So the key deliverable for this second stage, and again, this takes anywhere from 45 to 75 days because one, we're contacting buyers, distributing the material, conducting management meetings over a couple of weeks, soliciting letters of intent, and then the objective is to sign a letter of intent so that you enter into exclusivity with one buyer, and there's stage 3 that you're just going, it's the seller and one buyer that goes through the diligence process and the contracting phase. So stage 2, we're delivering all the marketing materials, we're conducting all of the meetings, we're receiving and negotiating all of the LOIs, and we're selecting one buyer, in general, one buyer to go into diligence with. Sometimes you might run a 2-stage process, just depending on how much interest there are and how strong the offers are. And in that case, you might bring 2 buyers or 3 buyers into diligence, where they will also send over a marked up purchase agreement. But for purposes of this process, we're going to say that we entered into exclusivity with one buyer. And stage 3 is entering into exclusive diligence with one buyer going through financial diligence, operational diligence, legal diligence, IT diligence, HR diligence, and also through the contracting phase. The main document being the asset purchase agreement or stock purchase agreement, but you'll also have non-competes, non-solicits, some other documents as well. That diligence and contracting phase takes anywhere from 45 to 75 days. Really just depends on who the buyer is, the complexity of the deal, and how efficiently diligence is run. And then you'll get to a closing. So all said, on the very quickest deal that we've ever done is maybe a 4-month process. In general, you see deals take from start to finish 5 to 6 months. And if something happens, or if there's an inefficient process, or something happens within the business that causes it to go for an extra month, sometimes you can see a process run for 7 months or longer. But in general, I would say 5 to 6 months is the average time to start and finish a process to sell your insurance agency, to maximize value and get the right strategic and cultural fit for your agency. Here's an example of the information for a retail insurance agency that we start with when we start building out the pro formas and the marketing documents. So last 4 years of income statements, and if you have this in Excel, I would say most agencies use QuickBooks. You have a current balance sheet. You have full year revenue projections for the current year and maybe for the next year. Book of business reports that show the carriers, clients, type of business. You're able to break this down by producers, showing both premium and commission. Have a detailed salary roster, shows all the name positions, the compensation structure for both your producers, if you're getting 50% new, 30% renewal, or if it's 40-25 or whatever it is, how bonuses are constructed, the full salary roster, the IT systems that are utilized in the business, key lease terms, and then the legal, are you an S corporation, LLC, a C corporation? What does your capitalization table or ownership information look like? Are there one owners? Are there many owners? What does that look like? The states that you're licensed as an insurance agency, as well as the states that you're licensed in and doing business in. And then are there any E&O claims or lawsuits or threatened litigation that have occurred in the past 5 years? So this is just like the initial information that you need to gather with your M&A advisor to put together a pro forma income statement to say, hey, this is what I think our agency's worth, and here's a couple of deal structures. Is that sufficient to sell my insurance agency? And then in general, once you have that pro forma number, insurance agencies are valued off of a multiple of pro forma EBITDA being earnings before interest, taxes, depreciation, and amortization. So once we strip out all of those items, we come up with a pro forma EBITDA number. For agencies that are less than $1 million in EBITDA, those trade at a multiple of about 8 to 10 times. For agencies that are $1 to $3 million in EBITDA, it's easy to get a 10 to a 12.5 times multiple in today's market. And then once you reach a scale of over $3 million of EBITDA, generally that equates to somewhere between an $8 and a $12 million commission revenue agency. Those can trade for anywhere from 12.5 on the low side to up to 15 times EBITDA on the higher side. So again, this is an expensive marketplace. These multiples, I would say, have plateaued over the last 3 years. Our second webinar coming out in just a couple of months will be on insurance agency valuations, how to value your insurance agency, how to create that pro forma EBITDA, common adjustments that go into it, what buyers are looking for, and what is market for a lot of key terms. The biggest one being owner's compensation, producer's compensation, things like that. But anyhow, this just gives you an idea of what current agencies are trading at. And you can see, those sound like high multiples, but here's what the public markets have traded for the past 10 years. 10 years ago, trading at 8 times multiple of EBITDA. Now they're trading at a 17 times multiple of EBITDA. And if you look as a multiple of revenue, they were trading close to 2 times multiple of revenue. Now they're trading at over a 5 times multiple of revenue. So as the public markets or very large private insurance brokerage firms have nearly doubled in their trading values over the past 10 years, that also has equated to, smaller private insurance firms also trading at much higher multiples than in the past. Here are some of the buyers that would, just a sampling of private equity buyers that would look at firms as on a standalone basis that are, larger, maybe over 3 to 5 million of EBITDA. You would have all of these firms have invested in insurance distribution firms. Most of them actually hold insurance investments right now. You have the GTCRs, Ultimate Capital, they own both distribution as well as carrier firms. White Mountains has been in and out of both the carrier business, the MGA business over time. You have some smaller firms like BHMS. BHMS was, I think their very first insurance investment was the Hill Group when it first got started. Now they have exited the Hill Group and they have investments into InsureZone and King Insurance. That's just 2 of their investments. Avery Partners, Aqualine, Century Equity, again, all private equity players that have had or hold multiple insurance brokerage firms. You have the publicly traded markets, Aon, which has just recently purchased NFP, AJ Gallagher, which has recently purchased Assured Partners, Brown & Brown, always a steady investor into insurance firms, Marsh McLellan Agency. These are all public markets that are active in the insurance acquisition space. And then you have private strategics. Almost all of these are backed by different private equity groups. You have some of the smaller ones and newer ones like Choice Financial Group, Trucordia, BNPCF, High Street, King, Insurance Zone. By newer, I mean they've been around for the last 5 or 6 years. And then you have some of the ones that started and have been private for a long time. Risk Strategies, Hub International, Aquashare, Assured Partners used to be on this list before they sold to Gallagher. But it's just a sampling of the different buyer types that you're thinking about as you're putting together your investor list. Here's all of the different buyers for last year. So InsureZone did 57 transactions, who they're backed by, when BHMS invested in InsureZone, and the like. You also have the publicly traded companies. Gallagher announced 22 deals last year. These numbers are illustrative. They come from S&P Capital IQ. There may be add-on and tuck-in investments that came along with them as well. Here's an example of what an anonymous fact sheet is. So this is a project that we did just a couple of years ago, Project REO Speedwagon, happened to be in Illinois. An S corporation tells you the key facts, right? Key metrics. This is a retail insurance agency, net revenue of 4.9 million, 1.6 million of EBITDA, shows you the mix of business, most of it being commercial lines with some personal, some employee benefits, how much of the revenue is from contingency income, what does this look like over the past 4 years and what we're expecting to do this year, how many employees they have. Tells you that it's in Illinois, but there's a lot of retail agencies that are doing about $5 million in Illinois, so it doesn't really give away any information that would identify which insurance agency this is. But this is what an anonymous fact sheet or a teaser document that we would send to all buyers on our investor list looks like. I'll just pause there and just leave that for a second so you can read through that. Shows who to contact if there is an interest. And then this document, we're not going to do a SIM. A SIM can be a 25 to 35 page confidential information memorandum, but this gives you a table of contents that goes into the SIM. And a SIM really is kind of like a 10K for a publicly traded company that we distill for each individual privately held project that we're doing. It tells about the transaction and process, the corporate highlights of the selling business, what their financial highlights look like, the business overview, so that's a mix of the line of business, maybe the states that they're doing business in, the products that they're selling. You have a few different pages on the products and services, maybe a few more if this is a specialty business, who their main carriers are. We might have a page on client concentration without naming clients, but maybe have the top 10 clients by revenue as a percentage of total revenue. Same thing with the carrier. So you want to know what the carrier concentration is, what the client concentration is. Are there any associations, any kind of marketing or sales that make this business special, right? Do they have proprietary products? Do they have any kind of association business that they have kind of a moat around their business, to, a competitive moat? Generally, we put the salary roster in there, a lot of times on a no-name basis. We'll also put, what the key producer compensation looks like, both on an actual basis and what we're selling it under a pro forma basis. Any key accounts or acquisitions that the company's done, the ownership information, and some of the corporate information goes in there as well. The, what type of business is it? How many owners are there? Where they're licensed? All of that information goes into your SIM. Of course, we have, appended to the back, all of the pro forma income statements, all of the adjustments that your M&A advisors has worked with to come up with that pro forma EBITDA, as well as an explanation for each individual adjustment that went into that explains why they're there. And then we have the actual unadjusted income statements for the prior 3 years, current balance sheets, historical balance sheets. All of that goes into the confidential information memorandum. And again, this entire document is delivered to each individual buyer once a mutual non-disclosure agreement is signed by both the seller and the buyer. And then we run a controlled auction. So controlled auction is a process where we've targeted, these 10 or 15 or 20 buyers. We solicit interest with the blind profile. We put the NDAs in place. We distribute the confidential information memorandums. Once those are done, we reach back out to all of those buyers, and then we schedule either in-person or Teams meetings over a course of maybe a 2 to 3 week period, just depending on how many meetings the seller and the M&A advisor think that is appropriate. The whole goal of that is to distill this down to we have 3 to 5 most relevant offers. And by most relevant, I mean by the best firms that fit strategically and culturally, that value the firm, and put together a letter of intent that best meets what the seller is looking to do in terms of valuation, earnout, and deal structure. We then, once we have determined that fit, we go reach back out to the buyers, ask them to submit letters of intent, inform them what we're looking for to be in the key terms of a letter of intent, and then we negotiate and try to get to an executed non-binding LOI with one buyer. What goes into a letter of intent is whether it's an asset purchase or whether it's a stock purchase agreement. Are there any liabilities to be assumed? One of the key liabilities that's almost assumed in every one of these is a lease, but you also have maybe carrier contracts, depending on if it's an MGA with just like one major carrier, and you line up the different carriers. Sometimes you see some type of associations or aggregator firms like a SIAA or a Renaissance Group or something like that, whether that is a contract that needs to be assumed. You have the price and the terms of the offer. The closing consideration, of course, is one of the main terms in there, but it also spells out the exact terms of the earnout. Is it a revenue-based earnout? Is it an EBITDA-based earnout? Is there a compounded annual growth rate hurdle rate? before you get into the earnout. In most earnouts, one firm does the average of the forward 2 years of EBITDA, and then places the same closing multiple that paid at closing on the average of the forward 2 years. So it gives the company, a very big incentive to grow for the next 2 years. Some firms do a revenue-based earnout so that there's no dispute on, hey, once you bought my business, the buyer's in charge of my expense structure. There's no argument over, hey, they bumped up my expenses to lower my EBITDA, I'm not hitting my earnout. So a lot of firms have gone to a revenue-based earnout. Sometimes earnouts are paid a little bit at the end of year one, and then at the end of year two, and then at the end of year three. Some of them are all or nothing at the end of year three. We've seen earnouts where there's a true-up mechanism at the end of the first year, and then the earnout runs for 3 years past the true-up. So there's any number of earnouts and terms that go into an offer. If the seller is keeping some equity in the business, oftentimes the letter of intent will spell out how there's a put call option at the end of a certain period for the buyer to buy the remaining equity and the terms that would be bought under. In every letter of intent, there is a exclusivity provision that says, hey, if we enter into this LOI, you're only going to negotiate with this specific buyer. Most LOIs have an expiration date as well. So if they submit it on, say, Friday, March 14th, then this LOI, this offer expires, say, March 21st. Usually gives about 7 to 14 calendar days. There's a due diligence clause that says the buyer is going to perform confirmatory financial diligence, legal diligence, operational diligence, HR diligence, and then the date that they expect to close. Generally, a letter of intent will spell out that the diligence clause, the exclusivity provision usually runs for 75 to 90 days, but the closing date is usually 60 days or 75 days from the date of the signed letter of intent. The common terms and conditions, again, we talked briefly about this, is the closing consideration, which is cash or equivalents. I say equivalents because A.J. Gallagher or Brown & Brown might give you 75% cash at closing that gets wired into your bank account and then issue 25% of the purchase price in their stock. But since the stock is publicly traded, that is the equivalent of cash. We talked a little bit about the performance-based earnouts. Most of those are based on a compounded annual growth rate over a course of 1, 2, or 3 years. And again, those can be either EBITDA-based or revenue-based. Whether the buyer is offering its own equity into the deal, so maybe it's 80% cash at closing and 20%, say, World Insurance stock equity, or the Hill Group, or Risk Strategies offers equity into the deal, or Choice Financial. There's any number of buyers that also offer some of their equity as part of the consideration. We'll spell out key employment agreements and key producer agreements. And then it'll also spell out the terms of non-competes or non-solicits that they're expecting the seller to conform to post-closing. And in general, what we see is 5 years is probably what the average is right now, sometimes a little bit less, sometimes a little bit more, but you can expect to sign a non-compete, non-solicit agreement for a period of 5 years. Then when we get into stage 3, we've signed a letter of intent, we're into exclusivity, we enter into diligence and contracting. And the buyer's key diligence tasks are: 1, financial diligence, and they will send over, as soon as you enter into exclusivity, the buyers will send over, 1 to 5 page either Excel spreadsheet or Word document that says, hey, here are all of the key diligence items that we're going to look at, from financial, operational, legal, HR, your M&A advisor. We would set up a virtual data room and set up all of the folders that correspond to the buyer's diligence request and start gathering this information. So that would be bank statements, tax returns, historical internal financial, agency management reports, processes and procedures, your employee handbooks, salary rosters, employment agreements, carrier contracts, lease agreements. All of this goes into different folders within the virtual data room, all organized, and the buyer will have different firms. So in terms of financial diligence, almost all buyers hire a third party outside either firm, financial firm, or CPA to do the financial diligence. Most of them run what's called a quality of earnings and will issue a quality of earnings report. So when our SIM said, hey, it was 4.9 million in revenue and 1.6 million in pro forma EBITDA, the job of the financial firm is to gather all of the information, all the carrier statements, all the bank statements, and confirm that there really is 4.9 million of net revenue that was running through that firm. And it really is 1.6 million of pro forma EBITDA, including, what's being paid for commissions, what's being paid on the salary roster, and looking at any kind of non-recurring revenue or non-recurring one-time expenses that have been pulled out of there. So anyhow, we're running financial diligence. The buyer will run operational diligence. Generally, the operational and human resource diligence, the buyer has internal resources to do that, and it's really just the financial diligence that a third-party financial firm is hired to do. And the legal diligence, both buyer and seller have their own attorneys. The buyer's attorney is generally a third-party attorney, although they may have a general counsel internal that helps run that. But in general, they're third-party outside firms that conduct the diligence and conduct the contracting phase of that. Here's an example of a timeline from start to finish. So one, we have populating the data room. That can take anywhere from 2 to 4 weeks. The same time that once we gathered enough information and we've had a couple of telephone calls and Zoom meetings with the sellers, we start to understand what they're looking for. We'll start to develop a target buyers list. Once we gather enough information, we'll start building out the information memorandum, the NDA, and the fact sheet. So all of that process takes anywhere from 4 to 6 weeks. Toward the end of that, we'll define with the seller, hey, who are we looking to target? Are we looking to do a big broad auction? Are we really going to a small, 3 to 5 kind of rifle approach buyers? We'll distribute the teasers and put those NDAs into place. Again, that takes anywhere from 1 to 2 weeks. As soon as we start receiving the mutual signed NDAs with both the buyers and sellers, we'll start distributing the SIM. And your M&A advisor will field written and telephone calls from the buyers, asking and answering questions on the information that was provided in the SIM. We'll go back and forth with the seller to help answer some of those questions. And then for a period of 2 to 4 weeks, we will set up those principal meetings with the decision makers from the buyers, as well as the seller and any other key employees that they think should be part of this, which could include financial or legal advisors as well. And then toward the end of that process, once we've had all the meetings, gathered relevant feedback from both the buyers and sellers, we will solicit and negotiate letters of intent with the objective to entering into a signed letter of intent with one buyer and then entering into the diligence and contracting phase. So from start to finish, right, we started gathering information the first month, we solicited some interest, we've gone out, we've distributed the SIM, we've held meetings. That takes place over a course of maybe a 2-month period. We get all of our offers in here at the beginning of month 4. Then we enter into a diligence and contracting phase where we're populating a virtual data room, conducting diligence meetings. A lot of those are our Teams or Zoom meetings, but some of those can be also 1 or 2 day on or close to on-site meetings in person. Financing finalizing the financial due diligence, which is often the quality of earnings reports from the buyer's side, and then gathering all of the different legal documents, the purchase agreement, the employment agreements, the producer agreements, the non-competes, non-solicits, the bill of sale, the assignment of lease document, all of these legal documents that need to be drafted by the buyer's counsel, sent over to the seller's counsel, marked up by the seller's counsel, and let me not forget the schedules to the purchase agreement, which can be just as onerous as the purchase agreement itself. Those schedules will include carrier list, contracts to be assigned and assumed, customer list, book of business reports. So all of those get either printed out or appended to the purchase agreement as schedules to that specific purchase agreement. It's a lot of formatting and maybe not duplicative work, but 1.5 times the work of just completing the data room. And if you pick the right attorney for your M&A attorney, and again, your M&A advisor will have a number of different recommendations depending on what your agency looks like to recommend a M&A attorney for you. They will make that process as effective and efficient as possible. So you definitely want an M&A attorney that is focused on and specializes in insurance distribution firm acquisitions. It just makes a world of difference, and even though they can seem expensive on an hourly basis, they are very efficient and definitely worth their fees. That process takes anywhere from 60 to 75 days, and then you get to a closing. The closing happens over maybe a 1 to 2 day period where all of the signatures of both the buyers and sellers are held in escrow by each of their respective attorneys. We have a closing call with all of the attorneys on the phone, with the M&A advisors on the phone, and with all of the decision makers on both the seller and the buyer side of the phone. Everyone agrees to release the signatures from escrows. The attorneys send over the signature pages, and the buyer releases all of the wire information that goes out to all the various parties in closing the deal. That whole process runs about 6 months. Again, this can be contracted to maybe run in the 4 to 5 month on an early side, and if some other unexpected items come up throughout the diligence or contracting procedure, this can run, to 7 or even perhaps 8 months. These are all of the definitive agreements. Toward the middle of this year, we're going to put together another webinar that builds out stage 3 in diligence and goes, in detail what goes into an asset or a stock purchase agreement and the schedules. What do employer and producer agreements look like? What are some of the key terms? What does market look like for producers? What goes into a non-compete and non-solicit? And both these agreements go into the stock purchase agreement as well as separately for each one of the producers or key employees. And then what are some of the ancillary documents, the bill of sale, the assignments, things like that. We're going to go into detail of what all of those agreements look like and what some of the key terms and what some of your expectations should be to looking at these agreements. So we'll have 3 webinars. This was the M&A process. We'll have one on insurance agency valuations, how to value insurance agencies, and then we'll have one on diligence and contracting. Hopefully you found this webinar to be helpful, and here's some contact information if you want to reach out to myself or Stephen Scales with the firm. Hope you have a great day today. Thank you.